The recession indicators, the long-term, when I say long-term, I mean the ones that have the best track record of being good predictors as further in advance, have been signaling a recession for a long time. So a lot of economists, and I would include myself, have said, there was going to be a recession in 2023. According to the data, that didn't happen. Maybe we fell into one around November, December. We won't know for another 4 or 5 months. We'll see what happens. But but it doesn't mean that the warnings were wrong, and it doesn't mean that we won't have a recession. It just means that it has taken longer to unfold than a lot of people expected. But now those same signs are actually getting worse.
In this video, Jim Rickards discusses indicators of a potential recession and analyzes the current economic landscape. Despite earlier predictions of a 2023 recession not materializing as expected, Rickards points out that the same recession indicators are now worsening. He acknowledges that the timing may be uncertain, but the signs are concerning. Rickards criticizes the recent employment report, highlighting discrepancies in the data. While the headline numbers showed job creation exceeding expectations, he points to a significant loss of full-time jobs, coupled with an increase in less rewarding part-time positions. This analysis challenges the optimistic narrative surrounding the employment report. The discussion expands to global economic conditions, with Rickards noting that Germany is in a recession, Japan is on the edge, and the UK is facing challenges. China's economic growth, while not explicitly labeled as a recession, is slowing significantly, contributing to the global economic concerns. Concerns about inflation persist, with Rickards emphasizing that while the rate of inflation is decreasing, prices are still rising. He critiques the Federal Reserve's reliance on the Phillips curve, pointing out the lack of evidence for its predictive power, and highlighting the lagging nature of employment as an indicator. The conversation touches on the Federal Reserve's future actions, with Rickards suggesting that the Fed is unlikely to raise rates further. He anticipates that the Fed might cut rates in response to a deteriorating economic situation, but by then, it could be too late, as the economy may already be in a recession.
I'm sure you've heard there was some very good analysis from a number of people. Jeff Snyder, Stephanie Pomboy, Sarge, Steve Guilfoyle, New York Stock Exchange, and others about how that unemployment report, the employment report that came out about a week ago, was completely misread. I mean, that was, the stock market went up,
Right.
Unemployment, job creation exceeded expectations, unemployment remained constant. That was consistent with the happy talk, with the Goldilocks narrative, soft landing narrative, etc. And so kind of stocks rallied on that. But if you look behind the numbers, I mean, there are two surveys. One of them showed about 220,000 jobs created. The other one showed 1.5 million full-time jobs lost. And then there were about 700,000, a little more, part-time jobs created. So if you net the two, you still lost 750,000 full-time jobs. And then, of course, part-time jobs aren't nearly as rewarding as full-time jobs. And then they'll show that, hourly wages went up. Okay, but there were fewer hours worked. That's how employers are managing the costs. Like, yeah, I'll pay a little more, but you work 30 hours instead of 40, so you're making less money. So there was, and then they gave a downward revision to the prior months. And for 12 months in a row, 11 out of the 12 months, they have downwardly revised the prior month's number. So why should we have any confidence in the 220? Because that's probably going to get downwardly revised next month. And when you're like 11 out of 12 months, that's not random. There's a certain amount of noise in the data. Everybody understands that. But that's something seriously flawed in the model. You don't get that. It's like, rolling the dice, getting a 6 11 times in a row. It doesn't happen, or it's extremely rare. So there's something wrong with the model. So there's a lot less there than meets the eye. Well, we have so far, but I think our luck has run out, if you want to put it that way. Germany's in recession. They just are. That data is clear, and it's getting worse. Japan is kind of right on the edge. Might be in recession. UK, same thing, right on the edge. The U.S. and China, saying China's in recession is probably a stretch. But if in China, if the growth goes from 10% to 7% to 5% to 4%, which it has over the last 10 years, that lost output is equivalent to a recession. China's trying to prop up their economy, so their economy is doing very poorly. When I see things like world trade contracting, it's not with the trade figures. Everyone focuses on surplus or deficit. So you have a trade surplus, your GDP goes up. You have a trade deficit, your GDP goes down. Or did the deficit shrink? That makes GDP a little higher, et cetera. Forget about that. I mean, yeah, okay, it's important data, but if you look at the top line, the exports and the imports, they're both shrinking. So whether the deficit gets a little bigger or a little smaller is less compelling, less important than the fact that both numbers are going down. World trade is shrinking, and that almost never happens except in recessions or during the Great Depression. Well, the Fed, of course, always says we're not political. We do what we're supposed to do. We follow the models. We're not political at all. That's completely untrue. They're highly political. They watch the headlines very closely. So they're aware of it. And you have to sort of put Jay Powell in context. He is a Republican, but he's a Bush Republican. There's no reason to think he likes Donald Trump or is a Trump supporter, et cetera. He's not a Democrat, but he's the kind of Republican who doesn't really like Donald Trump. So my expectation is, the Fed for now is not going to cut interest rates. They're done raising. That's pretty clear. You'd have to have some kind of inflation shock before they raise rates. That is unlikely to happen. Prices are going down. Well, sorry, the rate of inflation is going down. Prices are still going up. That's a big point of confusion. So prices are going up, but the rate of increase has dropped from 9% to 3% in the past 16 months. So that's progress. 3% is still well above the Fed's target of 2%, but they think they're at what they call the terminal rate. The terminal rate is the rate where it's high enough to bring inflation down without having to raise rates more. In other words, it's high enough to act as a brake. Just give it time, and inflation will come down on its own without further rate hikes. The Fed believes they're in that position. They won't be raising rates. So the question is, when will they cut rates? The answer is when it's too late. Meaning, the Fed are usually the last to know. And the best example I can give you, Danielle, is they pay enormous attention to what we just talked about, the unemployment rate. 3.7%. That's one of the lowest unemployment rates since the 1960s. I mean, it is extremely low. But they believe in this Phillips curve, and the Phillips curve is an inverse relationship between inflation and unemployment. So the view is if unemployment is low, inflation is going to get a little higher. If unemployment goes up, inflation goes down. So they're saying unemployment extremely low and saying, well, that's a little bit of a danger in terms of inflation. So we can't cut rates. But in fact, there are a lot of problems with that. First of all, there's no evidence for the Phillips curve. I mean, I can give you, do a quad chart. I can show you high unemployment, high inflation in the late 1970s. I can show you low unemployment, low inflation, in the mid 2010s, and so forth. So you can find every low unemployment and low inflation during the Great Depression. So there is no Phillips curve, or you constructed it. The Phillips curve, last time I looked, was a flat line, not much of a curve. So first of all, the Phillips curve is garbage. Secondly, employment is a lagging indicator. I'm not saying it's an unimportant number, but employers do everything possible to avoid laying people off. When revenues are drying up and margins are going down and profits are going down, they'll turn out the lights. They'll renegotiate the lease. Can't except fire people, because people are hard to hire. You get the talent, it's hard to find. You train it. The last thing you want to do is fire them. Recession has already started. In other words, it's a lagging indicator that tells you nothing. So my point being, Jay Powell is looking at lagging indicators. If unemployment starts to go up, which I expect it will, he will cut rates, but we will already be in the recession. So he'll have political insurance, because he'll say, well, yeah, we're cutting rates, but hey, we're in a recession, we have to. It'll help him avoid the charge that he's doing it to help Biden. I mean, it's the charge will be made anyway. They'll be in the political crossfire, but the economy will be so bad at that point, no one's going to blame Jay Powell.
Jim Rickards highlights prolonged recession indicators, global economic concerns, and potential Federal Reserve actions. He expresses worries about job losses and global economic challenges. The discussion emphasizes the political aspects of the Fed's decisions, predicting potential rate cuts during a recession. Overall, the video offers valuable insights into the complexities of the current economic landscape. If you found this information insightful, consider subscribing to our channel for more updates on economic analysis and valuable insights.